Carlos, kidogo. Choose for me the name.
So, first of all, what is revaluation? Revaluation, I don't write, is the difference between the book value of an asset, and its market what? Value. So if in the market the asset is being valued at 1 million, but in the books the asset you have recorded at 900,000, then it means there is a revaluation surplus of the 0.1. So whenever it can be downwards or upwards. So whenever there is a difference between the fair value of an asset and its carrying amount, then the difference is called revaluation. So how does deferred tax affect revaluation? Because deferred tax, remember, it is based on the temporary differences. And the temporary differences will depend on the cost of the asset minus the accumulated what? Depreciation. And when you revalue an asset, you will interfere with the initial cost of the asset. So how will that one affect deferred tax? So right here and say, revaluation is the difference. We are writing. Revaluation is the difference between the carrying amount, of an asset, and its fair value. Full stop. Another item, temporary differences. Changes with the proportionate change. In the carrying amount. Of an asset. As a result of revaluation. Full stop. Another item, revaluation gain should be taxed leading to a deferred tax liability. While a revaluation loss leads to a deferred tax asset. Full stop. Another item, changes in deferred tax as a result of revaluation. Should be recognized in other comprehensive income. in other comprehensive income. Should be recognized in other comprehensive income, but not in the profit/loss account. But not in the profit/loss account. Loss account, since revaluation is an equity component. Since revaluation is an equity component. Full stop. Can you go through that which we have written before I expound further? So what we are saying, how do you calculate deferred tax? What is the formula for getting deferred tax? Deferred tax, you take the temporary differences, you multiply with the tax what? Tax rate. How do you get the temporary differences? It is the carrying amount minus tax what? Tax base. So when you interfere with the carrying amount, because when you revalue the assets, you know when you revalue the assets, the carrying amount will be interfered with. So when you interfere with this, without interfering with this one here, it means the temporary will change. Actually, it changes with the proportionate value. So if this one is increased by 20, even this one goes up by what? 20. Then it will be taxed. That revaluation will be taxed. Now the issue we are having, you see, like yesterday, we were checking the deferred tax which goes to P&L. We were saying 0, maybe 180. So if the 180 includes revaluation, then that amount which was brought by revaluation defined by that P&L. Because you know revaluation, that's an equity component. Equity component does not go to profit account. It's a balance sheet issue. So to get what goes to profit, I will subtract how much. If the revaluation was 20, then this 20 was multiplied by 30, then I will subtract how much? 6. So P&L, you subtract the amount of deferred tax which was brought by revaluation. What I find an illustration so that I can be able to say. So write the illustration. Write the illustration. Write the illustration. Then you say ABC Limited had a deferred tax liability. ABC Limited had a deferred tax liability of shillings 200,000. Of shillings 200,000 on 1st January 2019. On 1st January 2019. Full stop. The company provided the following information. The company provided the following information. Provided the following information as of 31st December 2019. As of 31st December 2019. So assets, carrying amounts. The carrying amounts are in thousands. Tax base. So machinery, inventory, motor vehicle. So this is 10. Then 15. Tax base was 9, 8, 14, 600. Have those figures. After copying that, you say machinery had a revaluation gain of shillings 200,000. Had a revaluation gain of shillings 200,000 during the year. Revaluation gain of 200,000 during the year. Full stop. Assume a tax rate of 30%. Assume a tax rate of 30%. Required. Prepare the necessary journals. Prepare the necessary journals to record the changes in deferred tax. To record the changes in deferred tax. Good. So for you to record the changes in deferred tax, changes, how did it come from this to this, that to that? So one, you must calculate the deferred tax itself. So how do you calculate deferred tax? Deferred tax will be temporary times tax rate. How do you get temporary? You take the carrying amount minus tax base. So what I want you to do for me, come up. So me, I'm not drawing another one. Copy this one as part of your solution. This one here. Then now you add this column here. Temporary differences. Then deferred tax. So deferred tax at 30%. So what you do? So copy that one down there. Then you take the carrying amount minus tax base. Get them here. Then actually there is no need of computing deferred tax one by one. Get the total temporary. Then what you get is what we will multiply, because this is just 1 year. You know, those ones for different years. This is just single year with different assets. So just get the total temporary. Then deferred tax will be the total temporary times 30% tax rate. So do that. Good. So total, okay, the difference here is 1. This one is, and this one,
That's 100.
so total 600. Therefore, deferred tax is equal to 600 times 30%, giving you, it is 600. 900, sure. 900. So 30% of 900. To 70. So someone is asking, where did we start? John, let me share with you. So don't worry. Let me just take that picture. You just copy that. Catch up with it. So that is well shared. So that is 200 and what? 70. So the question was, prepare the journal entries to record the changes in deferred tax. So what we have is the deferred tax right now. For you to prepare those journals, prepare what is called deferred tax account. So have deferred tax account. Deferred tax account. Deferred tax account. So we said yesterday that deferred tax is a liability. So balance brought down. How much was the deferred tax at the start of the year? Huh? 200,000. So that is 200. Then balance carried down. Balance carried down, that is 200 and what? 70. So now, listen to this. The changes is from 200 to 70. So the balancing figure, don't have this. The balancing figure should go to the profit and what? Loss account. The increase or decrease in tax should go to the profit account. But now the problem we have, there was deferred tax. Sorry, there was revaluation. How much was revaluation? Revaluation ilikuwa 200. There was revaluation. Are you seeing the revaluation there? 200. So you know when you have revaluation, we were given the carrying what? Carrying amount. Sure. So the carrying amount, once you have the book value, already the revaluation is inside there. So inside the carrying amount, revaluation had been factored. It never affected tax base, but it increased what? Temporary difference. And whatever affects temporary will also affect deferred tax. Are we together? So inside this deferred tax, inside the 270, there is a deferred tax of how much? Take 30% of the revaluation. Tax that revaluation, 60. So inside the 270, there is deferred tax of 60, which came from where? Which came from revaluation. Which came from revaluation. Which came from revaluation. So if you tell us to P&L, it will be wrong if you write the 70, because inside the 270 there is 60, which came from revaluation. Revaluation should not go to the profit account. When you revalue an asset, that is a capital gain. So you come here and say you subtract it. You subtract that 60 from the 270, and you don't just subtract. You subtract by crediting the account. So you come here and say revaluation 30% of the 200. That is how much? 60. John, you just copy because you came late and you never saw that question keenly. Check until you read the question, you will see the 200 where we are getting this times this, the 60. So now it means what goes to P&L, the balancing figure. The balancing figure is how much? 10. 270. So can you synthesize that very fast before I go to the next? So now let me read what. No, it is not slippery. You just, John, today you came late. That is why you have lost track, but it is not slippery. He said the topic is very slippery. John, it is not. You will catch up. Now the question was, we prepare the journal entries. Journal entries to record what? The changes. So changes in deferred tax means how did it change? How did it change from 200 and what? 70. And when you are asked anything in accounting about journals, it means which account should you debit and which account are you supposed to do what? So this is how the journals will look like. So the journal entries is simple. Check here. The items we are going to pass in the journals are these two. This one and this one. So you have credited deferred tax account with revaluation. So you debit which account? Revaluation. So you debit revaluation because you have credited which account? Deferred tax. So journal 1, you say revaluation account will be debited because you have credited the deferred tax. So this is how much? 60. So you have credited deferred tax. Deferred tax account 60. Then you give us a narration to record the deferred, to record deferred tax on revaluation. Next, number 2, we have credited the deferred tax with P&L, so you will debit your profit account. So you come here and say profit stroke loss account, that is 10. Then you credit deferred tax. That is what we have done. Tax account also with 10. to record deferred tax expense. Correct. Correct. So we are done with that question. Can you open your past papers? You said it over group. Can you repost, please? Repost for someone joining today. So someone is reposting for us the question, the past paper question in the group. So be there. Those who have printed, I'm not sure, but I think last semester, not this last semester, the other one, there was a question on deferred tax. I'm not sure, but I want you have yours printed. Can you help me so that I can check? I tell you which is sitting exactly. Financial report.
Your local necessity. This one is easy.
So you have posted it? Yes. So someone has reposted. So let me just check for you the question very fast. Then we can be able to do it. So just give me a moment. I check it for you people. Yes, I've got it. Question 5. Question 5, which one? 5B, if I'm 5B of April 2022, last sitting part 1. So open your paper, April 2022. Question 5, yes, John, that is okay. So April Right there, April. So you don't copy the question, just write the setting because you have the paper. So you just be making reference. 2022, question 5B. So go through the question, read. They are calling themselves who? Yeah. Whichever it is. Zion. Go through that question, chop chop. Before I join. That is enough. So this one is different with the ones we have been doing. Eh? Somehow different. So what are they saying? But once you have the concept, you can do anything. Because what is required? Compute the relevant temporary what? Differences. So no matter how question is hard or easy, provided you know the formula, you can move. You can move. You just start from the formula, then God will bring answers as you progress. Let's see how God is going to bring it. What is the formula? They want temporary. So temporary differences. Now, before I move on, you remember the class we were proposing to be tomorrow? I'm told that Tuesday might be a public holiday because of swearing in. We can plan that day. We slot in some 2-3 hours. Oh, you are proposing that. That one can be better, sure. Yeah, so let's finish, then we zero in into that so that we don't inconvenience you tomorrow. Because from the experience I have, CPA people are not very social. So getting CPA people in the stadium that day will be very minimal. That one I know. Very minimal chances. The people who will be there, most of them are people sales and marketing, food and beverage. Those are the people who like working too much. So it's true. So we can spare 3 hours. We can just agree on time. Then that will be okay. So that on Friday, and even if we can compensate the 2 classes, it will be better for you. On Friday, you relax. And it is good to relax when you have already covered that class. Then relaxing, then covering it ahead. Sure. Yes, so Tuesday it is. So just take off time. What about non-Kenyans? Non-Kenyans, what will they be doing? The Queen, they will be watching the Queen. Or, oh, non-Kenyans, it means you will be working that day. I think that's what you try to bring in the picture, John, that you might be working. Yes, like that. So can you think of something very fast? Think of something so that, but I still have, like right now I'm recording the class. I can still record that day and send. This one today I have to send before I go out. Plus this one. Before I go out, remind me we sit here. Sure. Temporary differences is equals to carrying what? Carrying amount minus tax days. Please remember that this is the NBV, this is the WBV. Good. John, you are trying to tell me that if your country is celebrating, don't think everywhere. The celebration is not everywhere. John, that is noted, but we can always get a solution. Okay, so this is the formula. So when you study this question keenly, there is the assets, maybe there's the aspect of liabilities. So this is how we are going to get the temporary. Right there, they are calling themselves Zion. Zion Limited. Temporary differences. Temporary differences. Have that. Not every country is. So write for me here, assets stroke liabilities. Assets stroke liabilities. Right here, carrying amount. Carrying amount. I don't know whether there are thousands or millions. I've not even read the question. There are millions. Okay, thank you. So have them in millions. Tax base. Also have them in millions. Then you will comfortably get your temporary differences. Also in millions. So kindly have that. Good. So now, as we read, we just make the postings. What I'm trying to do, there is no need, yes, there is no need of reading from number 1, it's number 7. We read from number 1 to 7, then again we come and start afresh. No, they are not related. So when you read note 1, record the carrying amount, record the tax base. Sure. Yes. So there we go. So Zion Limited, a public limited entity, is in the process of finalizing its financial statement for the year ended that one. The following information has been extracted from its accounting records for the purposes of determining deferred tax. No problem. Number 1, inventory. So thinking begins as I have written the word inventory. So we are looking for assets and liabilities. Inventory is an asset. So write inventory. At least your neighbor in exam sees that at least you are writing. Yeah? So whatever is available, you take very fast. Don't wait. Inventory is stated in the financial statements at the lower of cost and net realizable value. Net realizable value, unless they're going to change the English ahead, realizable value is the amount you can get from the asset. And the amount you can get is always the book value of that asset. So unless something changes, what you need to report very fast is that realizable value is the carrying what? Value. Let's continue reading. The company wrote down its inventory by 120 million to a net realizable value of 1130. The reduction in value is ignored for tax purposes until inventory is done what? Sold. So the book value, they wrote it down to 11 what? 1130. 1130 is the book value. Capture that. Then taxman is coming with a briefcase. When taxman is very strict, they check this. And this one here, what they do, they check the cost, they subtract wear and what? Tear. And where the tear is not present, then the cost is the what? The tax base. So if you have not been given wear and tear allowance, then the cost is the tax base. The tax base which will be assessed for taxation purposes. So you don't allow people, because people can be subtracting with the main aim of understating what? Tax. So you only allow them to understand, to subtract if they were given wear and tear what? Allowance. So like in this case, they are saying it was written down by how much? 120. Where? It was written down by 100 and what? 20 to 1130. So what was the original value? Gross up very fast to get the initial cost before writing down. So can you gross up? 1130 plus 120 so that you get the cost. 1250. So the initial cost before writing down was how much? 1250. 1250 was the initial cost. Was there wear and tear? No. Then the cost becomes the tax what? The tax base. Is that okay? I hope you have understood what has happened. You gross back to get the initial cost. When taxman comes, taxman doesn't want to hear that you are, people will subtract to understate tax. So the taxman will gross back to the initial cost. Then ask you, did we give you wear and tear allowance? No. Then cost is what we are going to check for tax. But in the books, you can write whatever you feel makes you happy. So take this minus this, 120. Sure. 120, but negative. Negative temporary is called deductible temporary what? Differences. The negative is called deductible, which is, it will lead to deferred tax asset. Negative leads to asset. But in exams, when I'm asked you write the DTD, I'm just writing so that you can recall. Deductible temporary differences, that negative. So the 120, it was reduced by 120. they reduced it by 120. So what was the initial cost? I hope you get what I'm saying. Yeah, so you gross back to get the initial cost. And once you gross back, you ask, was there wear and tear? No. Then now that is the tax base. Let's go to number 2. Number 2, trade receivables. Thinking begins after you have written that. Trade receivables. Trade receivables. Has a carrying amount of 450. Once they give you the carrying amount, you don't think. You record immediately. $450. After making a general provision for doubtful debts of 30 million. The provision is not allowed for tax purposes. Gross back. They are saying the 450 is after deducting how much? 30. So what was the value before? Are we together? Yes, the value before is supposed to be 480. Then once you arrive at 480, you ask yourself, is there wear and tear allowance? No. So the tax base comes to how much? 480. So we have negative what? 30. Deductible temporary difference. Correct? I hope that is okay. Let's go to number 3. Property, plant, and equipment. Thinking begins after you have written PP. Property, plant, and equipment. What are they saying? Has a carrying amount of how much? 30, 50. And a tax base. Our life has been made easier. And a tax base of how much? So don't think, you know, sometimes it can be easy until you ask yourself, hey, is this me? Is this really correct? If it is given, it is given. Don't twist it again. When given the carrying amount and tax base, you record them the way they are. Okay? About that. Property was revalued upwards by 150. Once you have been given carrying amount, listen to this. When you have carrying amount is revaluation inclusive. You know, carrying amount is the book value. You only adjust revaluation if at all they mention it was cost. If it is cost, is when you top up. But if they say carrying amount, already they have adjusted what? Revaluation. So you know where revaluation will help us when checking the changes in deferred what? Tax. So mark that one. We'll come back later for that. So this is how much the difference? 300. But now this is taxable temporary differences. There are 2. Positive is called taxable. Even VAT. VAT, if you get positive, you pay. Negative VAT is a credit, which is an asset on your side. Sure. Yes. So positive is taxable. Negative is deductible. Very good. Good. Let's go to the next. Let's go to the next. Next, number 4. Yes. During the year, development expenditure amounted to this, which was capitalized, okay. Amortization of 20 was charged to P&L, no problem. This development expenditure was allowed for tax purposes in full during the year. When you incur development costs, that is, capitalization means you recognize as an asset. So development expenditure, right? Intangible first. Intangible assets, development expenditure. When you incur development expenditure in accounting, that amount is treated as an intangible asset. So what was the cost of that? That expenditure we incurred how much? 480. But they amortized how much? They amortized 20. So it means the book value will be 460. Because we incurred 480. Amortization is just the sister of depreciation. Treatment is one and the same. We depreciate fixed assets, we amortize intangible assets. So the treatment is the same. Depreciation, amortization, and impairment, one and the same. There is no distinction there. Jen, carrying amount minus tax base. Oh, I hope you are answering somebody. So you take the 480 minus the amortization of how much? 20. We go back now to tax base. Taxman doesn't want to hear anything, depreciation, amortization, impairment. What was the cost? We go back to cost. How much was cost? 480. Did we allow you anything? Yes. They have said, read the last bit. Read the last bit, what they have said. The whole amount was allowed for tax purposes. So the whole amount of 480 was allowed. It means now the tax base is what? Is 0. Yes, there is no tax base. There is no tax base at all. They have said the whole amount. The whole amount was allowed for tax purposes. So the tax base is 0. So you take 460, then this is also, it will be taxed. Next, if that is okay. That is okay. Let's go to number 5. This is number 5. Yes. Trade and other payables. Right, number 1. Trade and other payables. So what happened? Are carried at how much? 600. So have that 600. Good. Then we continue reading. Included in the payables are accrued expenses. So inside the 600, there's accrued expenses of 100 million, whose related expenses are deductible for tax purposes on cash basis, paid basis, whichever. So what they are saying, inside this 600, there is 100, which will be allowed for tax when done what? Paid. Sure. So it means now the amount we are supposed to assess for tax is how much? 500. The 100 will be allowed for tax when the amount is done what? Paid. You know, accrued means not yet paid. So they are saying it will be allowed for tax only when it is paid. So remember, this is a liability. You cannot add liability to the assets. So liability, make sure they are in bracket. You don't add liability together with the assets. So this is 600 minus this. This is 100. Even that one is deductible. Next and last, no, number 6. Deferred tax liability as at 1st November when we started was 272. So that was the opening. The deferred tax is 30%, no problem. We are done. These are the temporary which they were asking. So you can add if you want, but the examiner just wanted this one. Here. How many marks? 5. Sure. Yes. So how is the 5 marked? 1, 2, 3, 4, 5. Not these ones. This is what is marked. Those ones. So can you add for me that? Positive, eh? So I'm told that is 510, which is true. So 510 is taxable. Positive is taxable. So that is what the examiner wanted there. Then required Roman 2, which is 4 marks, deferred tax account. Deferred tax account. So even before we go to deferred tax account, can we get that deferred tax itself? So down here you say, therefore, deferred tax, we report deferred tax as a not liability. Liability because it is positive. Right? So deferred tax liability, positive is taxed, is 510 times 30%. So take 510 times 30%. You get 153. Thank you. So this is 153. So they want us to prepare deferred tax account. Before I prepare deferred tax account, let me give you 2-3 minutes. Just go through this one, the entire workings. If there is any which we captured, you are not very comfortable, you copy because copying was there to be copied. I can be able to explain further before we go. Online people are okay. You're also okay. Then let's go to deferred tax account. Let's go to deferred tax account. We were working in millions. So how much was the deferred tax at the beginning? The one which was appearing in number 6, 272. So you come here and say balance brought down 272. John, you see now you are following this question. Now you are relaxed. That other one you came late. Then at the end of the year, we have gotten tax of how much? Deferred tax of 153. But now, so balancing figure, here is where now people go wrong. The balancing figure should go to profit account, but there was revaluation. You remember? That tax on revaluation is part of this 153 because it affected the carrying amount. Carrying amount in turns affects the temporary. Is that okay? So there is deferred tax which is here on revaluation. And revaluation should not go to P&L. So you subtract, you say here revaluation. How much was revaluation? It was mentioned in which notes, ladies and gentlemen? It was mentioned in which notes? Not 3. Not 3, where are you? Yeah, property was revalued by 150. So you take 150 times what rate? 30%. So how much is this? 25. So tax has decreased. So it means, and there is something somebody asked on the physical class, online, maybe you never had it. He was asking what about if revaluation was a loss, which is very possible. All the two we have done are gains. What if it's a loss? If it's a loss, you bring it here because it had understated this. So you bring it, just the opposite, you bring it this side if it's a loss. So 45, it means our balancing figure to P&L, balancing figure will be how much? 164. 164. Okay. So the total. I have that total. It's not that bad. Sure. If you know the concept. That is it. What if you are told to prepare journals? It was not asked, but they can ask next time. Can you be able to? Yes. So journals, when you are told to prepare journals, the things which will go to the journals is this. And this one here. Only. You don't capture the journals, the opening and closing, the differences. In which case, the first, you will debit revaluation, then you credit deferred tax. 2, you will debit deferred tax, then you credit P&L. As simple as that. As simple as that. So that is all. That is all. That is all. When we meet in our next class, I don't want to start another topic right now. Saturday is always very tricky. So many people are not there in session. So our next topic will be borrowing costs. So right there, topic IAS 23. In government, they use IPSAS number 5. Borrowing costs. Borrowing costs. Borrowing costs. That is our next topic. That is our next topic. By the way, we are moving. So Tuesday, we have said what time? Apparently, there's a class we have already agreed, 7 to 10. There's a class we have already agreed 7 to 10. So we can meet from, what have I said?
The class we've agreed from 7 to 10.
No. That class we have agreed, what time? 7 for 3 hours. 7 to 10. Maybe call someone there to confirm. I forgot how. No, we said 7. 7 to 8, 8 to 10. That is the time we have agreed. Yes, we have agreed on that time. Yes, we have agreed 7. No. 7 to 8. 8 to 10, 10 to 11. I think kindly don't log out. Let me confirm so that we be very precise. Let me call someone from that class so that I can be able to know, so that I don't bring two classes which are clashing. That one is not picking. It will take a few. Let me just call another one randomly.
Purity. A quick one. We agreed the Tuesday class will be for what time? Oh. Oh, yes.
Oh, 7 to 10. 7 to, yeah, sure, okay. Oh, I think I'm becoming old. Eh? We agreed their class is tomorrow, not Tuesday. So fine. So you can decide for Tuesday. And why are we coming on Tuesday? Why are we coming on Tuesday? To compensate the ones which will not be there in advance. So far I've not scheduled any class on Tuesday. So Jen is saying 11. No, I think we can come early so that those who are going to celebrate, those who are going with somewhere. I think 9 is appropriate. Yes. Let's do 9 to 12. 9 to 12 will be enough for me. Non-stop will compensate for those others. Sure. So write it in your diary. Then, John, in case there is one you will miss, I will record that class just the way I'm recording this. This one I want to send. So thank you. Thank you.